Hello friends, today we'll be discussing Best Buy. Best Buy is an American multinational consumer electronics retailer. It offers a wide range of products to its consumers, such as computers, cameras, software, and customer service, across all states in the USA. Over its existence, the company has built a powerful brand that is respected among its customers. Now let's move on to the company's financial indicators. It can be seen that the company doesn't show any trend either towards growth or decline in its revenues, and a similar situation applies to its net income. As for the company's assets, it's a complete nightmare, which we'll discuss later. My final rating for this company is 1 out of 10. I was very interested in this company, but when I delved into its development strategy, I lost all interest in it. While the company holds a significant share in the sale of electronic devices and has a powerful brand that it has developed over the years by providing its services at affordable prices and creating competitive advantages, such as the Geek Squad for assisting customers with PC or hardware they buy at Best Buy. However, although the company lags behind its competitors like Amazon, Target, and Walmart, they have their own advantages that encourage customers to buy from them. Over the past 20 years, the company has increased the number of its stores almost fourfold, from approximately 300 in 1999 to around 1,200 in 2023. And although everything seems fine, after digging deeper, I made the decision not to buy the company's stock. The fact is that although the company operates approximately 1,200 stores, it only owns 27 of them, leasing all the others. The company spends its hard-earned money everywhere but on the development of its business. Consequently, it pays out 5% in dividends, which is 65% of its net income, and also buys back shares from the market. But most of all, I don't understand the purchase of medical companies. Yes, that's right, a company that has earned the trust of its customers in the sale of electronic devices for years is now trying to associate itself as Best Buy Health, which sounds absurd to me, simply a waste of money. Moreover, the company completely withdrew its business from Mexico, which is just shameful. Think about it, the company developed there for several years, served customers, and then just left the market, which, in my opinion, is simply unacceptable. In my opinion, the company won't survive with such an approach to business due to the following mistakes. The company is not yet big enough to pay out 65% of all its revenues in the form of dividends. They could have directed this money towards acquiring property and logistics or storage companies that would help provide the company with competitive advantages or simply compete with Amazon and others. Instead, they just pay them out in dividends. The company is developing in the wrong direction. Best Buy is a brand associated with selling technology, not some medical company. This field is too competitive in terms of medical services, and the company has nothing to gain because competitors will simply outbid it. The company withdrew from the Mexican market, which, in my opinion, is unacceptable. The company was losing money due to COVID, all they had to do was cut dividends. Now the company will be associated as an unreliable partner in leasing, and I'll remind you that out of about 1,200 stores, only 27 are owned by them, which will increase the company's expenses in the future. The company is clearly trying to balance two chairs by staying in the PC or hardware business while expanding into other sectors like healthcare, and it's absurd. My forecast for Best Buy is that there will come a time when it will simply be bought out by Amazon, Walmart, Costco. The company is currently too risky to buy, although its assets are valued at $15 billion, but I just don't understand where this figure comes from. Considering that the company still has $12 billion in debt, this gives us $3 billion in real assets. In fact, the company has almost no assets, with almost all stores leased. So, with $1.5 billion in cash and considering the equipment stored in their stores at $3 billion, this is indeed a fair price for the company, adding value for its powerful brand. I estimated at $4 billion, which is 4 times less than what it is currently trading on the market. In other words, its fair price is $20 per share, not around $75. If the company doesn't change its approach, it will simply go bankrupt and then be bought out for next to nothing by major retailers until it can focus on its core business. I will definitely not buy shares of this company under any circumstances. Subscribe to my channel so you don't miss my next videos.